Want to know the fastest way to turn a profitable contractor into a broke contractor? Buy a truck. Now, before you click away, I'm not saying don't buy equipment. I'm saying most contractors buy it with the wrong money, at the wrong time, and for the wrong reason.
Welcome to what I call the tax season truck trap, the expensive mistake that sinks contractors every single year.
Hi, I'm Wade Carpenter, CPA with Carpenter Company CPAs. For more than 35 years, I've helped business owners build stronger construction companies. I've seen companies doing $2 million, $5 million, even $10 million a year end up scrambling to make payroll, not because they weren't profitable, but because they confused a tax deduction with a sound business decision. Somewhere along the way, contractors were taught that if you have a profitable year, the answer is simple. Go buy a truck, buy a skid steer, buy another piece of equipment before December 31, so you can just write it off. The problem is the IRS doesn't make your equipment payment. Your cash flow does. A tax deduction doesn't magically put money in your bank account. It simply reduces the amount of income you pay taxes on. But the check you write or the payment you commit to is still very real, month after month, long after the tax savings have been forgotten. That's exactly why I built the capital expenditure or CapEx account into the Profit First for commercial construction system. In this episode, I'm going to show you how to know when you should buy equipment, when you should keep renting, how to build the cash to pay for the major purchases before you need them. Because the goal isn't to own the newest truck in town. The goal is to own a business that can afford it. Let's get into it.
Here's the thing about construction cash. It doesn't flow smoothly like a nice little creek. It lumps, like boulders rolling down a mountain. One month you're flush because 3 customers paid early. The next month you're counting quarters because equipment season hit like a tornado. The original Profit First system works fine if you run a steady business where the biggest surprise is running out of printer paper. But construction, we're dealing with equipment-heavy trades facing massive seasonal cash spikes tied to replacement schedules that don't care about your convenience. Let's do the napkin math real quick. Say you generate $2 million annually. Your equipment replacement cycles might demand $200,000 every 3 years. That's $66,000 per year, or about $5,500 per month you need to set aside. Miss a few months, and suddenly you're facing a $75,000 purchase with $15,000 in reserves. You know what happens next. You start eyeing job cash and customer deposits like a starving man eyes a ham sandwich. And it happens every day because contractors don't have a dedicated CapEx reserve. Without one, the temptation gets real dangerous, real fast. Think of PFCC's account system like organizing your pickup truck. JobEx is your toolbox. It covers everything that directly serves the job. Subs, materials, job labor, permits, and crucially, job-specific equipment rentals. That money is sacred. It belongs to specific projects. OpEx is your cab. Overhead costs, admin expenses, and the ongoing debt payments that keep the truck running. CapEx is your savings jar for the next truck. A reserve funded from OpEx, never from JobEx or customer deposits, to accumulate purchase power over time. The critical rule that separates the wise from the foolish: CapEx gets funded from OpEx only. This firewall keeps job cash pure and protects your delivery capacity. The minute you start rating job cash for overhead equipment, you've stopped running a business and started playing 3-card monte with your customer's money. Here's the rental versus ownership line. If you rent a mini excavator for the Johnson project, that rental stays in JobEx. It's a direct job cost. But equipment you'll use across multiple projects gets purchased through CapEx and then serviced via OpEx when you make the monthly payments. Quick example, you got $80,000 in JobEx, earmarked for materials on 3 active projects. Your skid steer dies, and the replacement costs $45,000. If you borrow from JobEx, you've now got $35,000 to cover $80,000 in material obligations. The math doesn't work, and your projects are about to blow up.
Let me give you 5 rules that aren't suggestions, they're survival.
Transfers into CapEx come directly from OpEx allocations. JobEx stays reserved for job-specific costs. No exceptions, no emergencies, no just this once. The day you break this rule is the day you start jeopardizing project delivery. Rule 2. Time separate the decision from the cash. Use steady, small transfers to turn a big, risky cash moment into a manageable, pre-funded event. It's the difference between saving up for Sunday dinner all week versus showing up at the grocery store Sunday morning with empty pockets and a hungry family. Rule 3. Protect OpEx reserve floors first. Maintain 2 to 4 months of OpEx on hand before approving any CapEx purchase. This isn't a suggestion, it's a guardrail that prevents growth stage insolvency. That ugly moment when your shiny new equipment sits in the yard while you can't make payroll. You wouldn't drive your truck with no oil in the engine, so don't run your business with no cash in the reserves. Growth without reserves is just an expensive way to go broke. I watched a contractor buy a brand new backhoe one December. Beautiful machine, yellow as a summer squash. 2 months later, he couldn't afford the fuel to run it, and it sat in his yard for 18 months before he sold it for 60 cents on the dollar. That equipment didn't make him money. It made him broke. That's the perfect example of why Rule 3 exists. Rule 4. Account for the whole cash picture. After you buy equipment, factor the ongoing debt service into OpEx using PFCC's cash-adjusted method. The purchase leaves CapEx, but the monthly payment moves into OpEx where it belongs. And that's where PFCC adds back principal payments to show you the true cash demand. Too many contractors see the tax deduction and forget about the next 5 years of payments. That's like buying a horse and forgetting it needs hay. Rule 5. Never use deposits or JobEx to buy equipment. Customer deposits must remain segregated to fulfill job obligations and maintain audit defensibility. Using deposit money to buy company equipment? That dog won't hunt, and it sure won't pass an audit.
Before you get excited about buying equipment, you need to understand something called your cash commitment base.
This is the percentage of every revenue dollar that's already spoken for. JobEx plus OpEx as a slice of the pie. Let's do the math real quick. Say you've got $2 million in revenue, $800,000 in JobEx, and $960,000 in OpEx. Your cash commitment base equals $800,000 plus $960,000 divided by $2 million. That's 88%, which means only 12% remain for profit. Owner's pay, taxes, and any CapEx dreams you might have. The brutal truth, if your base is 88%, you've got limited room to carve OpEx dollars into CapEx without choking operations. It's like trying to squeeze 10 pounds of potatoes into a 5-pound sack. Something's got to give. Here's the mistake that kills contractors: trying to mask a weak base with financing. PFCC treats principal payments as real OpEx cash outflows because, surprise, they are. If your base is already choking your cash flow, adding a new note payment is like throwing gasoline on a fire. Before you commit to equipment, review your base like you'd check your wallet before walking into a casino. Improve pricing, tighten JobEx control, or trim OpEx overhead to lower the base. This creates safe capacity for CapEx transfers without starving day-to-day operations.
Let me show you how this works in the real world.
Say you're renting skid steers constantly. JobEx shows $8,000 a month in skid steer rentals across projects. Should you buy? Here's the napkin math. Rental cost, $8,000 a month equals $96,000 a year. Purchase option, a $75,000 skid steer with $1,200 a month in debt service. Annual savings after you own it? $96,000 minus $14,400 equals $81,600. You break even in about 11 months. But before you get excited, run PFCC's validation checklist. Will ownership stabilize total cash? Yes. Saves $81,000 annually after break-even. Can you pre-fund the down payment? Check your CapEx balance. Will OpEx floor stay intact after you add that $1,200 a month payment? Model it. If all three check out, ownership improves your cash commitment base and cash flow. If anyone fails, keep renting and sleep peacefully. Math beats opinion every single time.
Equipment should never be an emergency. If replacing a truck or buying a new machine creates a financial crisis, that isn't bad luck, it's a planning problem. Build your CapEx reserve. Protect your operating cash. Let math, not emotion or tax advice, drive your buying decisions. If you'd like the complete Profit First for Commercial Construction System, grab the book on Amazon or visit ProfitFirstConstruction.com to learn how we help contractors implement it in their own business. If this episode helps you think differently about equipment, subscribe because we got a lot more construction cash flow lessons coming your way.